Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, June 1st, 5:21 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in an uptrend, more specifically, large cap tech-led uptrend. Commercial real estate and regional banks continue to be on the avoid list. Check our 3 time frame and leader trend gauge over here. Market leaders acting just fine, showing uptrend. Short term, the 5 major indexes versus the 21-day moving average. Big tech is leading the S&P 500 and the NASDAQ 100 to a very clear uptrend. Small caps, mid caps, and Dow struggling with their 21-day moving average. Medium term versus the 50-day moving average, very similar scenario. S&P 500, NASDAQ 100 clearly above their intermediate term 50-day moving average. Small Dow and mid cap struggling. Long term, all 3 big cap indexes above their 200-day moving average. Multiple tests of the Dow against the 200 over the last week or so, but it has held mid caps and small caps unable to get back above. But we saw a little bit of momentum from them today. So what happened today? We opened just about flat, a little bit on the positive side. Dow not opening positive as one of its bigger tech components, CRM, Salesforce, gapped down on earnings. It opened down 0.4%, but did rally to positive. But we based for a little bit, and then late morning, like about from 10 till noon, a little bit after noon, a very strong rally, taking us firmly into the green. Then we went sideways early afternoon, tried to quick, harsh sell-off late in the day, but we rebounded. Nice numbers on the close. Here they are, RG8. This is our 8 ETF, 8 growth ETF composite. We use this to keep our finger on the pulse of the broad growth uh, sectors. Up 1.2%, S&P 500 up 1%, NASDAQ 100 up 1.2, Dow up 0.5%, mid caps up 0.8, Russell 2000 up 1.05, Global 60/40 up 0.77, minor participation from bonds, foreign developed stocks up strongly, in-house GROTECTION up 1.01%. We'll hit the tail of the tape and charts of interest. Got a lot of bullish charts to take a look at tonight. Let's dive right into it. Here's the S&P 500. So things were looking bleak on the 24th, last Wednesday, breaking back below, looking like a failed breakout above this 4150-ish level. After some harsh days, this was tied to the debt ceiling and a lot of people blaming it on a looming recession, but whatever. We had a big gap up, big strong gap up on Thursday after Nvidia blew earnings out of the water, had followed through on Friday, Monday a holiday, big gap up on Tuesday. This was the irrational exuberance gap up that I've been mentioning, and we reversed hard, just got a little too extended to the upside, and then pulled back more yesterday. We held right where we needed to on a short-term basis with an undercut reclaim of the 8 EMA. Today, this morning was looking, really non-eventful at the start, just a follow through to the range that the pullback range from Wednesday. And then, boom, uh, the market seeks to fool the masses. A little bit of a gap down. We try to rally. This gives you a little bit. Well, first we sold off, then we rallied, then we sold off, then we're rallying. And you're wondering when the next shoe is going to drop lower. But we blasted above 4190, approached 4200, natural round number resistance area 4200. We went sideways in here for about 20 or so minutes and then blasted above there, and it was off to the races for another 0.5% rally up to 4221. 4221, very clear resistance. We went sideways for a couple of hours, false breakout, couldn't make it. 4216, the bottom of the range held. We tried again and it worked all the way up to 42.32. But this was a pretty harsh, pretty quick 0.5%, 20-minute sell off here, all the way down to 42.12, and then strength into the close, closing right at this 42.21, which ironically was resistance mid early afternoon. So, and we're slightly higher above that after hours, up about, I don't know, 0.1% after hours. Uh, so you can see the S&P 500 got down to oversold on the 5-minute chart here. That's where we close. See if that carries through tomorrow. Let's go to the daily chart. Good stochastic here. Blipped down yesterday, back above, back pointing in the right direction today. And no matter what the bears try to sell you, higher closing recovery highs aren't bearish. Yeah, it's led by big, large caps. The horrific 2-day sell-off of AI stocks seems to be over. That stopped. Semiconductors their foot in their line in the sand today. Nasdaq 100 2-day sell-off stopped. New closing highs. That's not bearish. FANG stocks continue to work. AI stocks continue to work. So this 2-day sell-off was met with buyers. Didn't even touch the ADMA on the pullback. Yes, we're extended. Where are we? 9.1% above the 50-day moving average. That's extended, no question about it. We got 10% extended on Tuesday, pulled back and closed yesterday at 8%, back up to 9% today. It's extended. Expect volatility. When things are running strong, people are quick to take profits, but on any pullbacks, people that have been lagging realize they need to get in to take advantage of it. And that's what today looked like after a 2-day sell-off. Hey, these things have pulled back enough. Let's take advantage of that and try to get in. And we've been enjoying using the 60-minute stochastic lately, and you can see we got on the Nasdaq 100 just above oversold when we snapped back and the rubber band went higher. Very strong recovery. Let's check that same stochastic on the S&P 500, right above over sold, didn't quite get down there, and a slingshot higher. So Nasdaq 100 and S&P 500, can't really complain about anything that I'm seeing there. How about the laggard large cap index, Dow Jones Industrial Average? I talked about how CRM held it down some today. CRM finished pretty well off the lows. Let's take a look at that chart very quickly. You can see it's a strong chart. All it did is pull back to the 21-day moving average and bounce. In fact, we saw a lot of uh, stocks with good charts just pulling back to their 21 and bouncing today. CRM certainly among them, and the Dow ended up just bouncing off the 200-day moving average. So you can see how many times it's been tested, 5 times over the last 7 sessions. Won't break the 200-day. That's good stuff. Uh, Putting in a base, trying to put in a bottom to form the right side of a cup higher. Let's check in with mid caps and small caps. These lagged yesterday as there was quite a bit of selling in the regional banks. And here's the mid cap today recovering a good bit of that loss, ran into the declining ADMA, not quite to the 21. So not a great effort, but a good enough effort. We'll look at a 15-minute chart here, and you can see it acted pretty much like the big cap indexes did. Not a lot of divergence as far as the intraday action on the indexes went. Open near flat, sold off, and then rallied and based into the close. That's mid caps, IWM, a little bit healthier, a little bit up higher in its shorter term pattern, and in fact, closing just barely above the 80 MA, the 21 EMA, and the 50-day moving average. Let's see. I talked about this yesterday. Let's see if we can get a little bit of a rally and take another shot at the 180 level, which is also the 200-day moving average. Recall back last week, they had a nice run. Small caps had a nice run into it, but was soundly rejected at the declining 200-day moving average, just not ready to get above it yet. You can see several times this year. We also made runs at this 180 and 200-day moving average level and got rejected every time. So that would be a big feather in the bull's cap to get above that level. Let's take a look at the dollar. One of the reasons the rally today was a supposed strong day in the dollar. This is a bad print. If you look at the 1 minute chart, this last 1 minute, I don't know what the heck happened here. After hours, we're back up around 2830, 2840-ish. So right back up around here. I just don't really know what went on with that last minute there. That's a bad print though. But the dollar was weak today. That benefited stocks, and it also, as you might have guessed, benefited precious metals. Here's gold. So the 1 day inverse correlation went away. It's back again today. You can see this is a 4 day rally off the bottom now in gold into the declining 21-day moving average, GDX gold stocks rallying for the second straight day strongly off the bottom into the declining 21-day moving average. So today's high is a pretty important level on both of those charts. You can see how oversold we are on gold and gold stocks. Let's check silver, up 1.6% on the day into the, you guessed it, declining 21-day moving average. So keep an eye on that dollar, stock, and precious metal correlation for tomorrow. How about the VIX? The VIX had a huge sell-off today, down 12.8%. This may be new closing lows, 1565, 1578, new closing lows for this recovery. How about that? Uh, Man, quite a move down. Bears just can't believe it, can't fathom it. No, it's not happening. Yes, it is happening. Price and volume, pay attention to them. That's all that pays. The headlines don't mean anything. The actual prints and what's going on with stocks is what matters. Yes, I know it's bifurcated. You can make money in a bifurcated market if you're on the good side of the bifurcation. And that's the way we roll here at Revere. But regardless, big move down on the VIX. And let's go to bonds now. Broad bond index. Bonds were up across the board for the fourth straight day, meaning their yields pulling back a bit, coming off of oversold. So the prices can go higher, which would bring, from a stochastic standpoint anyway, prices can certainly go higher, bringing yields down. Let's go to the TLT, the long bond. Prices up again here, not by much. And let's check the actual yield, TYX, the 30-year yield down 0.6, 4 days down. So we broke out of this range, trying to establish the top of another range, and really we're just back into the prior range. So no real significant trend here. You can see how range bound this has been between 35 and 40, going back to last November. So making higher highs and higher lows since April. So I guess you could say that from that definition, which is the definition of a trend, the trend is up. We're currently pulling back within that trend. TNX, the 10-year yield, 0.80, pulling back again for the fourth day. So let's see, Bitcoin, the last one to check. If I didn't have my note next to my laptop, no telling what I'd forget. Down 3% on Bitcoin today. Not in sync with the NASDAQ 100, which it often does sync up with in times. And tried to get back above the 16 level. That's looking like it tried to, which is, it looks like 16 has now flipped to resistance, which is not a good thing for Bitcoin. How about equal weighted? RSP up 0.75 today, not as good as the index, but not bad. Still in a downtrend. QQEW 0.68. Hey, that's a new closing high there. And relative strength has been cooperating over the last 4 weeks for the equal weighted NASDAQ. So that'll tell you that tech is in charge across all sizes, not necessarily just above the massive caps. That's it. On the inter-asset correlation that we do in every video, let's go to the tail of the tape now. You can pause this. One thing I want to point out is sentiment, AI, fear, and greed. Let's bring up a snippet here. This is the AAII. This is on their website. Now, Bulls still low by historical purposes at 29%. It's up each of the last 2 weeks, but the historical average for Bulls is 37.5%. The high this year, 37.5%. So we're making highs on the year, but the bullish percentage is still a full 8.5, 7.5 points below where we were. So this tells me from a sentiment standpoint, we certainly have room to run. More bears than historical averages at 37%. The neutral, of course, in the middle. Uh, Bearish high last September, 60.9%. That put in the bottom. This is a really good contrarian indicator, and this is why we're including it on the tail of the tape. So, yeah, bulls up for each of the last 2 weeks after a big drop down. Really, we're just where we were 3 weeks ago at the 510 levels, and we've rallied since then. So that's our sentiment update. So we're still operating under the bull case, up 3 of the last 5 days. News: House passed the debt ceiling agreement. It goes to the Senate now. Another Fed head said pause. This has brought the odds of a rate hike down to 22%, so 78% against any hike over the next at the next meeting in 2 weeks. And this is significant because it was in the high 70s just 2 days ago before these Fed guys started saying, hey, maybe we'll take a pause and see what the data how it plays out. Doesn't mean we're done, but maybe pausing for a month, and the market seems to like it. Let's see if the market likes the jobs report in the morning. That tends to be a market mover. ADP data came in today, and it was kind of in line with expectations. Didn't seem to move anything. Speaking of expectations, ours are still positive as long as the S&P and the Nasdaq are above the 21, and they are. Here was the trend during the day. I already showed that intraday chart. Semiconductors up, gold, and silver stocks, oils, regional banks with a big snapback, and solar's trying to make a resurgence up today. On the downside, cyber led to the downside by CrowdStrike, but CrowdStrike, which is initially looking like a big gap down. Nice chart. Where did it bounce? 21-day exponential moving average, and a beautiful move off the lows. So all the way down from 143.50 to close at 157. This thing was bought with both hands on the pullback. You never really can tell how a gap is going to play out, whether it's to the upside or the downside. Look at this example, another stock in the same sector, Okta, gap down, bounced off the lows, but still down 18%, bounced at the 200-day moving average. So yeah, it may have put in the low, but still down 18%. Not good there for OKTA. Another example of you really never know how a gap is going to play out. Macy's initially gapped down, ended positive for the day. Another retail stock, obviously not a retail department store, but Dollar General gapped down, stayed down 19.5% during the day. We're going to take a look at some more earnings related charts in a minute here. But first, an update on the portfolio. We trimmed some SQQQQ on the strength, added to AMD, and bought an AI ETF chat. We've been digging through a bunch of them that are out there. There's reasons to hold them, or there's pros and cons of all of them. As of right now, I like chat the best. We're going to talk on the podcast tomorrow about why. So we took a starter position in that, and we trimmed some T-bills. So we dropped over the last 2 days from 20% T-bills to 15% T-bills because we need some cash to invest in stocks, which are looking much better than T-bills currently. We like the way the market's firming up, and we're going to put money to work until the trend ends. So the bottom line for the day, bulls back in charge, strong late morning rally across all the indexes. Let's take a look at some key movers and some nice charts that aren't in the 21 over 21 or in our portfolio, but are noteworthy nonetheless. So let's go through highlights from the portfolio today. NVIDIA, everybody thought that the rally was over yesterday with the reversal off 420, back up 5% today, right around that 400 level, um, holding strong. We added to AMD today, again, taking it from, so we sold when it got extended just to lock in some gains. We sold right around 120 here back on the 25th. Didn't expect it, as extended as it was, to run up to 130, but it did. But a pretty abrupt pullback the last 2 days allowed us to get our 1% back and then another percent below 120. So we're up to 3% with gains. It's about 3.5% on AMD on this nice bounce off the 21-day moving average that corresponded with a 60-minute stochastic cross up today. So added to AMD in the portfolio. Chat is a new ETF, but the names in it are very well known. 1-day pullback for Chat. I like how it's set up, and like I said, we'll take a look at it on the podcast tomorrow. Let's see what else is in the portfolio that was noteworthy today. Meta continues to rally, making higher highs, riding the 8 EMA. DT gap down 2% at the open, closed up 1.2%. This is a nice low volatile stock in computer enterprise, software enterprise group with a AI component to it, making higher highs. If they all acted like this, my blood pressure would be lower than it is. DT, Tesla also struggled early, but showed strength throughout the day, making new higher highs. Uh, this 20 above the 200-day moving average, the 200 level, and to the top of the base here, around 208-ish. Great volume accumulation patterns, excellent relative strength. Since they had their shareholder meeting 3 weeks ago, things have swung to the upside of this, and it tells me that there are some big players accumulating this. Maybe it's Fidelity Contra, who went a long time without owning this, and maybe when the next ownership, oh, look, there's Fidelity Contra, but with a tiny uh, percentage of the fund. But there were some positive comments from Fidelity Contra Fund manager I've read over the last couple of months. Maybe he's finally dipping his toe deeper into the water. You never really know, but clearly accumulation is going on with Tesla. So that looks pretty good there. Uber also started weak, but strengthened during the day. Again, off the 21. So the stocks did their job today in the portfolio, along with the big SSO position that we have. Now let's take a look at a couple of others. AEHR got some news on a client buying their test systems. This thing has been very volatile, but forming a nice cut base here and a big move up today on volume, up 16.7%. Pure Storage reported earnings up 19%, big gap with volume. Celsius, which I got stopped out of earlier in the week, bounced where it needed to at the 21, and nice volume today, looking to possibly re-enter this back above the 80 MA. Just a matter of selling it on Tuesday when the market was looking weak. It continued down yesterday, bounced where it needed to. Maybe some impatience on my part, but when the market's going lower and something I have is underperforming versus the S&P and all buys are negative, um, it didn't hit the max stop loss. It was proprietary sell on my part, but they're not always going to be perfect. I don't claim to be, and this is never always clear cut, no matter how many rules you try to put in place. DraftKings, same thing. We got stopped out on this a little while back, bounced off the 21 EMA. It went through two big periods of relative strength underperformance, which is why we got stopped. But maybe kicking back into gear today looks a lot like Celsius, with a rest over the last week and a half and some strength coming in today. Marvell had a great reaction to earnings, got a little ahead of itself, strong 2-day pullback. If you bought at the highs, you were hurting, but looks like a bottom has been put in near the lows of the gap up day. Marvell now going sideways. This is an AI chip leader also. After hours today, MongoDB up big, up 21% on big volume on their earnings report. It's trading up around 356 after hours. So, hey, MongoDB wants to be a player again. And Lulu, we got stopped on Lulu. Now let's take a look. Let's dive in here a little bit to Lulu. Lulu was the biggest position in our portfolio back at the beginning of May. And then it just started leaking lower. This was about the time that Foot Locker came out and said apparel. They had a terrible earnings report. They said apparel was slowing. Apparel sales fell off a cliff as well as their sales. They reduced guidance. Pretty much most footwear and athletic wear started selling off at the time. So look at Lulu here. You've got 7 straight days of selling, a 2-day bounce. Okay, it's done, right? We got a bounce back above the 21-day moving average, but the volume was anemic. And then we have 1, 2, 3, 4, 5, 6, 7, 8, 9 straight days of selling. Fund managers wanted to get rid of Lulu in just selling it with two hands. Major breakdown on the stock, came all the way down to the 200-day moving average. Big volume over the last 3 days. They reported earnings after hours. They're up 13.5%. So maybe there's no recession for the affluent, as Lulu is a high-end retailer, trading at 372-ish. So right about where the initial right about where it broke out above after its last earnings report, which was well received for about 6 weeks before it completely fell apart over the last 5 weeks. So Lulu back all the way up here. We got stopped out in here. Some when it broke the 21, the rest when it reclaimed and broke the 21 again. But very clearly, I wasn't the only one that was wrong on Lulu here. When you have 16 out of 18 days that it's down, that's not accumulation. And you can just take a look here and see the accumulation distribution rating on this thing is an E, which is the worst possible. And with that, I think we're going to wrap it. So remember why we do what we do here at Revere. It's to avoid big losses. That's our number one job. And then when the market gets back to a healthy posture, we start participating in the indexes and leading stocks in leading sectors. And that's certainly working right now too, and continues to work. And that's the approach that we'll take until it changes, because we follow the trend across 3 time frames here at Revere. And if you're interested in this approach, reach out to me, Don at revereasset.com, or my partner, Dan Stewart, Dan at revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much of that you can keep. And with that, I will wrap up the first day in June. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.